the Extension Coordinator here for Peace Country Beef and Forage Association. Also with me tonight is Katie McLaughlin, our interim operations manager. She's going to hang out in the chat and help keep track of questions and make sure that we don't miss anybody who's got a question in the chat or any of that sort of stuff. If you're not familiar with PCBFA, which I saw by the poll, there are some people who are brand new to never heard of PCBFA before. We're an applied research and extension group based out of Fairview, Alberta. We do, we're run by a board of 10 directors who are ground level producers here in the Peace Country. They help guide what we do for research projects and help us do what we do. We do small plot trials of forages, perennial forages, intercropping, cocktail cover crops, all that fun stuff here in Fairview, but also at some satellite research sites around the Peace Country. We have on-farm trials as well for grazing management and pasture rejuvenation research. We do extension, obviously, events and webinars. We have a monthly newsletter. We have a bi-weekly podcast called Coffee, Cows, and Crops, where we chat with local experts, international experts about all things agriculture. We also provide production advice and expertise based on our local research. If any of that sounds interesting, if you want to follow us, you want to keep track of the events we're doing and that sort of stuff, you can follow our website, peacecountrybeef.ca. You can follow us on Facebook, Twitter, Instagram, all that good stuff. You can email us, you can call us. We're happy to chat. Oh, I do. I have a bit of an agenda tonight. The plan is that we will... The plan is that we will start with a presentation with Steve. Then we will have some breakout discussions, let everybody discuss what Steve has said. And then we'll have a bit of probably a 5-minute break, and then we'll talk about gross margin calculations and play around with some of the calculators Steve has got set up. But I think that's all I have. So with that, I will stop talking and let Steve get right into the good stuff.
All right, sounds good. Thanks to everybody coming. So far, we've got, what, 75 participants? That's a good turnout. Pretty excited about that. If you have any questions during the presentation at all, don't hesitate to put them in chat. We might not get them yet, but then we remember to get back to them, right? You might forget about the question you thought about 20 minutes earlier. So don't hesitate to put a question into chat, because we'll come back to it at the end. So as we're going through here, if you're not quite sure about something, please feel free to throw that out there. So I will share my screen. Okay, does everybody see my anatomically incorrect bull? Awesome, awesome. All right, we will kick into this. I had an exchange student come work for me quite a few years ago. I think the first time he showed up was about 2005, and then I hired him back. He was so good, I hired him back as a manager. He was actually from Bogota, Colombia. And so he was with me for a couple of years, and probably the best employee I ever had. And a few years ago, I got to go back down and actually go to Colombia and visit him again for his wedding. He got married. So my wife and I went down for a nice trip, and he made the point of telling me that he said the most important thing that he learned from me on my farm when he was up here was the fact that there's a difference between economics and finances. And that actually blew me away, because 99% of the people that learn anything from a seminar, they look at production practices, right? They, oh, I learned how to graze, or I learned about water systems or fencing or driving tractor, right? All these production things are so important. And it was very impressive to me that that's what he came back with. That was the number one thing he learned. He didn't realize before that there was a difference between them. And that's an important distinction that I've found a lot of people don't really get. So I'm going to simplify things tonight. If this is way beneath you, I apologize, but I like to keep things simple because I'm a simple guy. There's a big difference between economics and finances, okay? On my farm, economics is profitability, whereas finances is my cash flow. Okay, different set of numbers, different set of paperwork that I'm working on. Let's put that in an example. Let's say that on my farm, I've played around with the idea and I've decided that I'm going to try and grow apples. Right, we're going to put an orchard in, and there's a shortage of apple cider vinegar. Wink, wink. I have trouble getting a hold of it, so I'm gonna do my own and have this orchard that I'm going to start up. So I run my gross margin analysis that we're going to go through today. And I come back that I can make $10,000 an acre in profit, right? That's it, right on. That's a great idea. We should do that. So that's the profitability side of it. Now, the financial side, picture this. I've got to get a hold of the land, and I've got to plant the trees, prepare it, get it, get the saplings, get them seeded in there, probably put a big fence around it to protect it from the wildlife. And then I have to wait 5 years before I can actually harvest my first crop, right? Because the little trees take time to make before they're actually producing. Can I actually cash flow that? Can I put all that money out in advance for 5 years before I actually get to take any profit, any income in? Okay, that's somehow I've got to finance it. So there's a big difference there. And a lot of situations, there are profit centers or enterprises, whatever you want to call them, that are economical, but they're really hard to cash flow. Or there's other situations that you can easily cash flow something, but they're not economical. Okay, so we have to be sure that we're running both sets of numbers and understanding it. And be careful about whose advice you take, because there's a lot of, I hope there's not too many bankers on the call here tonight, but there's a lot of bankers that will encourage you to do something that you can finance that is completely and totally economically unsound. Right? I've had bankers try and tell me to do stuff like, we'll give you a loan for this, or we'll give you a loan for that. So it's up to you as a producer to understand both the economics and finances. Okay? That's something that we have to manage. All right. So where I'm coming at with this, why this is so important. I don't know if anybody's seen this chart before, but I try and put it up at just about every presentation that I do. This was a study by Darren Coleman. He finished it, about 2017, I think he finished it, but the study goes from 1926 to 2016. So it's a little bit older, but I think it makes a clear point. He took the net farm income over those 92 years or whatever it is and worked it out on what percentage of that dollar does the farmer actually get. So if you look at this chart, the top of the blue line is the total farm income over those years. And the top of the green line is actually the percentage that the farmer gets to take home. So anybody see anything wrong with this picture? Okay, it's from about 1985 on, things went downhill, right? And it points to note about this chart. Ag business, well, obviously the blue, ag business is taking the majority of the money. So that's all your, all your dealers, your fertilizer, your chemical, your, all the middlemen that are taking a little chunk of the pie. In 1985, it really started to hurt the farmer. If you notice, the red is actually when the drought and BSE hit Canada. So that really hit Canada. In the US, that actually would have spiked up a little bit. Not a whole bunch, but a little bit, because they had better prices during that. And then another change was in 2007. All of a sudden, it started going up again. That was when the ethanol market was opened up in the United States. And that gave the grain farmers a little bit of a boost. So the beef guys still didn't get quite that much, but the grain farmers got a little bit of a benefit there. But if you notice, though, when that ethanol market kicked in, who got the biggest bonus? Who got the biggest chunk of the pie, right? This peak way up here. So this is wrong. We need to fix this. And I'd like to try to put a little bit of blame here. Do you guys know whose fault this is? Who caused this to happen? It was the farmer. Sorry to hurt your feelings, but we choose to buy products. We choose to, to believe the marketing. They're really good at marketing. Right. And we need ag business. I'm not saying that they're evil, major corporations, but back here it was fair. All right. We need them. We need to buy products, but now the percentage is way out of whack. So it's our decisions to be able to choose this. So what we need to do is understand our own numbers. And the biggest problem I believe we have in agriculture right now is that producers do not understand their numbers. They don't understand there's a difference between economics and finances. We're taking advice from bankers. We're taking advice from accountants. We're taking advice from salesmen and reps. We have to stop taking advice, and we have to start figuring this out on our own and actually doing gross margin analysis, running our own cash flows, and start to manage our own businesses instead of letting everybody else tell us what to do. Okay, so this is my passion right now. I want to solve this chart. Okay, I want to help people to figure out their own numbers to be able to move forward and get a little bit bigger chunk of the pie out of this. So that's my goal. So I hope I don't insult you too much tonight. I'm trying to encourage you that there is a way to get out of this, but this is a reality. In Darren Qualman's report from 1985 to 2007, right? So that very low period there, 100% of total farm income went to ag business. Farmers made nothing, right? They lived off inheritance, off-farm income, unpaid labor, selling assets, selling land, land appreciation, right? Nothing. And if you extend that out from 1985 to 2016, so you include this little green part here, the farmer took home 2%. Okay, so there's 98% there that went to ag business over that period of time. So once 1985 hit, it was pretty well downhill from there. So I'd love to see this extended, right? I'd love for Darren Qualman to add to this, and let's see where we're at 2021. But I'm guessing it's pretty similar. And I'm going to say that most of, if you're from the United States, this is going to be pretty similar, right? It'll have variations, but the concepts are about the same. So that's what we want to solve. Hopefully we can get a little step of the way tonight. So I'm going to simplify this. I said I like things easy. So I'm looking at the big number, which is the gross product. Okay, and from there, I also need a little number, which is the cost of production. A lot of times when I've been at seminars over the years, usually around the coffee pot or in the discussion, there's always a bit of an argument between farmers, right? One will be saying, well, you know what, I do this production practice because I make more money. Okay, an example was, you know what, I feed my cattle because my calves get bigger and I have more money when I sell them at the auction market. Or there'll be another farmer there that arguing that, no, you know what, I'm doing better because I lower my cost of production, right? We swath graze all winter, right? It doesn't, my costs are really low, so I'm doing a good job. Who's right? Right? Is it the guy making more money or the guy that has less costs? They argue all the time, and every time it's a different topic, it's a different subject, but it's always the same argument, right? One guy's doing better than the other. Both of them, in my opinion, are wrong because they're not using the right number. Okay, the important number there is the difference between them, the margin, right? So that's why we're going to look at a gross margin analysis tonight. It doesn't matter how big your calves get if your costs go up. Okay, so here's an example. Here's your typical margin, right? A big number minus a little number, there's your margin. If you were to creep feed and your costs go up at the same amount that your revenue goes up or your gross product goes up, then you're no further ahead because your margin stayed the same. Or if you're that swath grazer and you lowered your, cost of production a whole bunch, but your weaning weights dropped. If your margin's the same, you're no further ahead. Okay, so the goal of this is to spread that margin. Get that margin as big as you can. Okay, a lot of people don't quite understand that, but there's only 3 ways to make more money. Okay, only 3 ways. You can make the big number bigger, so you can somehow manage to get your gross product higher. Okay, that's easy enough. Or you can make the small number smaller, right? Try and get your costs down. But if either one of those affect the other one, maybe you're not getting farther ahead. Okay, so you get that margin spread. The third way is to increase turnover. If your big number is as big as you can get it and your small number is as small as you can get it with your management and your situation and your environment, then you can increase turnover, so do more of it to make more money. But first off, you have to do number 1 and number 2. One of the biggest problems in agriculture is people try to start with number 3. Okay, so this is the normal in agriculture. even though some of us don't even realize it. And I'm going to explain why in a second. But the big number is usually the small number, and the small number is a big number, and we end up losing money, and we don't even realize we're doing it. So we end up with a negative margin. At this point, if you increase turnover, what happens is you lose money faster. I know this seems very basic, but it's unbelievable the number of farmers that do this because they don't know their numbers, right? The number of times people have said, well, if I just get more cows, well, you're losing money right now. If you get more cows, you're going to lose money faster. So we have to make sure the spread on that margin is adequate before we start increasing turnover. All right. So there is one type of business that has a 90% success rate. Okay, most small businesses fail within 10 years, right? If somebody starts up a new business selling widgets, within 10 years, I think it was something like 80% of them are no longer in business after 10 years because they don't understand the business behind it. They don't understand the economics and the finances, so they fail. Now, farms are a small business, but they don't fail at an 80% rate. But there's one type of business that has a 90% success rate, and that's a franchise. Okay, we all know franchises, Tim Hortons, McDonald's, A&W, right? These are all franchises. The reason they're successful is somebody else has already done all the numbers. They understand the business side of it. They've set a model, and now they sell the model that works. Okay, so those businesses, 90% of them succeed because someone's done the numbers. If you start a business on your own and you don't have that background, 80% of the time you fail. Now, farms are small businesses. Why don't they fail? Okay, it's because we subsidize them. Okay, there's numerous ways we subsidize them. So most farms are in this situation, right? We got the big number is too small and the little number is too big. So here's, if you watch the graph here, you can see how we subsidize. So government subsidies, obviously, we get a little bit of money here for fencing. We get a little bit, we got crop insurance here, drought insurance there. We get some money from the government because we're the poor farmer. So there's a little bit that gives us a boost to our gross product. Okay, we also do unpaid labor. So our costs actually are less than they actually are because we don't pay ourselves, right? If you can't pay yourself a reasonable wage that you would pay someone else to do that job, then you're not really running a business. Okay, so unpaid labor is another subsidy. Off-farm income. Okay, off-farm income, a little bit of a dilemma here. I have no problem with you having an off-farm job as long as it's not subsidizing the farm. Okay, what happens is, let's say we have a small farm that you can only produce so much income for yourself. Okay, let's say your household needs $50,000 to survive, and your farm can only produce enough labor and or profit to pay you $20,000. So somebody, you or multiple people from the farm will have to work off to bring in the other 30, right? Your farm's just small. Nothing wrong with that at all. No problems with that at all. Where I have a dilemma is when you need $50,000 to survive, so you have to get an off-farm job to make $70,000 because you got to input $20,000 into the farm every year. Okay, that's where I have a problem with it. So be clear that an off-farm job is not a bad thing. I know when I started this up, I had people in the sustainable management area who would criticize me because I still had an off-farm job. Well, if your farm's really small, where else are you going to get the income? I mean, yeah, if you do 4 hours of labor a week, you're not going to make a living at that, right? If it's a small farm. So you need to have some money from somewhere else. But when that off-farm job is putting money into the farm, that's where I have an issue with it. Land appreciation is a major subsidy to the farms. Since 1985, realistically, most farms survive just because of land appreciation. If it wasn't for that, most of them would be broke, right? It's not necessarily a direct cash input into your business, but your balance sheet went up. So now you can go get a loan to buy a new tractor, or you can buy a new piece of equipment because your equity is higher. Now you have borrowing power. So land appreciation has been a huge, huge subsidy in agriculture since about 1985 for sure, right? If it wasn't for that, most farms would be broke. And inheritance, right? You inherit a piece of land, now you don't have to pay rent on it, so you farm it, and we're going to talk about opportunity costs coming up, and there's another term called opportunity rent. If you own the land, we still assign a rental rate for it as if you had to rent it from someone else. So just because you inherited something doesn't mean that it's free. If you wanted a business to be repeatable, you have to account for that. So as repeatable, I mean that's another word that I could use as a franchise. Okay, so I might use that term a few times tonight. Is your business repeatable, or could you franchise it out? And that's an important thing to make. One of the best gifts the older generation could make to the new generation coming in to take over the farm is to make sure your farm's repeatable. Okay, and what I mean by that, if mom and dad, so we'll talk about mom and dad for a second, and then the next generation coming under. If mom and dad are comfortable, right, they've got their land paid for, their herds paid for, their equipment's paid for, and they can cash flow their farm business. They have enough money coming in that they can pay all their bills, maybe take a vacation, go to Jamaica, wherever they want to go. They can afford to do that, and they're comfortable. But all that stuff's paid for, and they paid for it with these things: subsidies, unpaid labor, off-farm income. They worked hard, right? Land appreciation went up. They got a bonus. They could borrow more or do more borrowing power, and they're comfortable. However, if the next generation comes in to take over that farm and manage it the same way, they can't do it, because now they have a loan payment for all those things that are already paid for mom and dad. So that extra cash flow that they bought the new pickup with and went on a vacation with, well, that's getting sunk into a loan payment. So they can't farm the same way. Land appreciation is a lot higher. So when they bought the land, they got to pay a lot bigger mortgage on that land. So it's just not the same thing. So we have to work differently than the last generation because the economics has changed. And we've got to make sure that business is repeatable if we're going to hand it over to the next generation, or else they're going to fail anyway. So that's a gift that mom and dad should give to the next generation, is to make sure that business is franchisable or repeatable. Okay, so we end up thinking that we have this little bit of margin here, but in reality we don't, because of all these subsidies. So that's how we keep going, and we decide, oh, well, let's just get more cows or more sheep or more whatever we're doing, because we think that we're profitable when really we're not. So when we're looking at economics, tonight's about economics, tomorrow night's about finances. So we'll look at economics tonight. After we pay ourselves labor, I just talked about the unpaid labor, we have to cover three things when we're looking at our gross margin analysis. So we have to pay all of our opportunity cost. Now, I touched on this a little bit already, but I'll explain it again. Opportunity cost is the option, or the opportunity to invest in something else. Okay, think of it as a measure of your management. Could you invest it into something else and make more money doing nothing? Or are you investing it in your farm, working your butt off and not making as much money? Okay. It kind of replaces your loans. Let's say you have a piece of land worth $100,000, just to keep the numbers even. You own $50,000 of it, and the bank still owns $50,000 of it. You've got it half paid off. So you're still paying interest on half of that. You've got an interest payment on $50,000. The other $50,000 is paid off. You're not paying any interest on that. But the opportunity cost on that is the same as your interest. If you sold that land, you'd have that $50,000 to invest in something else that could be returning you an interest rate instead of costing you an interest rate. So we've got to be doing better than what we could have it invested at on our farm. Okay. So a lot of people have trouble wrapping their head around that, but I'm going to tell you, you don't see it in your bank account. That number doesn't show up in your finances, but it is a real number. So we've got to make sure we're accounting for that. The best way to get your opportunity cost figured out is maybe the interest rate on your highest loan at the time. So if you have a truck loan at 6%, okay, your opportunity cost across your farm should be 6%. if you've got a credit card at 13%. Well, your opportunity cost is 13%. Because you could sell whatever asset you're talking about, whether it be animals or equipment or land. If you sold that asset and paid off this other loan, you would save yourself that percentage. Okay, so your opportunity cost is to save yourself that 6% on that truck, because you could sell that tractor and pay off that loan. So that tractor better be making you more than 6%, or is it really worth owning it? Now, there's other reasons why you would own something, but on a strictly economic perspective, is it worthwhile owning it? Okay, and that goes for livestock. It goes for anything that any asset that you're owning. So we have to cover our opportunity cost. Earlier, I talked about the opportunity rent. If you own a piece of land, we put on a rental rate, what market value is in your area. Okay, so if you own the land free and clear, we need to assign a value to it, because if the next generation came in to take it over, they have to make a payment on it, or they have to rent it from you. So to make sure that that business is viable, let's put a opportunity rent on that land to see how you would do if you had to pay for the rent. I know that you have it paid off and you don't have that. That's where you go to Jamaica. But to see if the business is viable, we have to put that opportunity on it. Okay. Depreciation. We have to cover depreciation as well. We all know about the brand new pickup you buy off the lot depreciates really fast. Okay. Some of the old equipment that you bought years ago isn't depreciating very fast. So this rate varies depending on the equipment. But the actual calculation is your purchase value minus your salvage value divided by the number of years you owned it. Okay, so if you bought a tractor for $30,000, you owned it for 10 years, and you sold it for $10,000. Okay, so there's your purchase value of 30, your salvage value of 10, and you owned it for 10 years. So we've got $20,000 in depreciation divided by 10 years. That's $2,000 per year in depreciation. Okay, now in theory, you need to cover that. Okay, so what we need to do is out of that, the revenue that tractor is creating, now this could work with livestock or anything else that you're buying, but the examples with a tractor, out of that revenue that tractor is making, we need to put $2,000 away every year, right? If you wanted to put it into a bank account, you could call it your depreciation account. You put $2,000 into that every year to cover the depreciation on your tractor. Okay, at the end of 10 years, you decide you're going to go out and replace your tractor. So you've got your $10,000 because you sold your tractor, and then you've got 10 years times 2,000, you got $20,000 in the account. You got $30,000, you can go out and replace your tractor. Okay. In theory, that's how you would cover your depreciation on your business. Now, in reality, over the last 20, 30 years, what's happened is we've gotten appreciation in our land. So when our tractor is wore out, we can just use the appreciated land value. We've got a higher number on our balance sheet. We can go get a loan. Okay, so if it wasn't for land appreciation, we wouldn't be able to go out and buy a new tractor. We'd be stuck with the old one and the old repair bills. So that's how we've been surviving over these years. So we have to be covering our depreciation to make sure that a business is repeatable. Okay? Now, you don't actually have to put that money into a bank account, right? If you want to invest it into another part of your business that is profitable, let's say you had a sheep herd, and it's $2,000 every year to cover the depreciation of your tractor, you're going to go buy sheep with that. Well, and if your sheep are making a profit, hopefully they are, because we're going to do a gross margin analysis on them too, right? Then when your tractor needs to be replaced, you already know, well, I just have to go sell some sheep because I've invested that into my sheep profit center, and it's been making me a profit the whole time. And now I can sell some sheep and replace my tractor. Okay, so I mean, in theory, you could do any combination of that, but on paper is what I'm getting at, is we need to cover that depreciation somehow. Okay, all right. Inflation. Okay, Bank of Canada tries to keep inflation at about 3% a year, right? Plus or minus. Now, whether they do that or not, I mean, it's pretty close. But we need to cover that because in 10 years, the price of gas is going to be higher than it is now. So I want to make sure that I'm covering inflation during my business analysis as well. Now, in my gross margin analysis that we're going to quickly look at here, in opportunity cost is covered, depreciation is covered, inflation is not. But what I do is at the very end, if I'm not over 3% return on investment, then we're not good enough. I've got to be at least 3% over. So technically we do inflation at the end, but I want you to know that that's one of the things that I want to make sure I can cover too. Okay, so that's just a quick synopsis of it. I don't want to depress you, but opportunity cost could be anywhere from 5 to 10%. Depreciation could be anywhere from 5 to 10%. So let's say 15 each, let's say it's 15 total, and inflation's at 3. So we're looking 18% return on assets just to break even. And that's after we've paid ourselves labor. Okay, I don't want to depress you, but you remember looking at that chart, and the average over the last, well, since 1985 was 2%. So we got a long way to go to catch up, but we can do it. Like I said, I don't want to depress you. This is a way forward. This was the biggest breakthrough my farm ever had when I learned how to do a gross margin analysis. I completely changed my thought process. It gave me a direction. It made decisions easy, right? That was the power of it. One of the first time I saw a gross margin analysis, I've seen it about 3-4 different places now, but the first time I ever saw it was at a school called Ranching for Profit. I'd highly recommend anybody to take it. But one of the phrases that I remember from there very clearly still, and that was 20 years ago, the easiest way to make more money on the farm is to stop doing things. And I'm like, what? That doesn't make any sense. The easiest way to make money on the farm is to stop doing things. So let's say you have 5 different profit centers, right? They're all lumped together. Your accountant gives you the numbers back and you're losing money, or you're making a little bit of money maybe, but everything's lumped together and you can't see them clearly. They're not separated. Well, once you figure them out separately, I call them profit centers. You could call them enterprises or profit centers. You start breaking them apart, you might find that 3 of your profit centers are making money and 2 of them are losing money. Easiest way to make more money is stop doing the 2 that are losing money. Now you have more time and more energy to focus on the 3 that are making money, and you will make more money, right? Interesting way to look at it, but in some cases, that's the easiest thing to do. Okay, so let's look at this. I'm going to kind of draw out a little schematic here. It's going to start out simple and then it's going to get complicated. And don't worry, we're not going to go into the whole thing tonight, but I'm going to show you the whole schematic. I've simplified this to make it easier to do it on a quick basis. But to make a profit, we need to take a big number, which we're going to call the contribution margin, and we need to subtract a small number from it. And that's my business overheads. Okay, right off the bat, most farms have this backwards. We're already going wrong. But that's my goal, to make sure my contribution margin is bigger than my business overheads. The contribution margin is made up of a gross margin minus your profit center overheads. Again, I want a big number minus a little number. Okay, and then we look at our gross margin. It's made up of your gross product minus your direct costs. Now again, big number minus little number. See, it's really that simple. The complicated part is that we do it over and over and over again, right? We break our businesses into these different profit centers. So everything there in blue would be one profit center. Okay, a profit center could be your cow-calf profit center, or you could have a finishing profit center. You could have a pasture poultry profit center. You could have a pig profit center. You could have a grain profit center. You could have a feeders profit center, right? We can add these up. I've had farms take my school that have over 20 profit centers. Okay, you could have a vegetable profit center. But all of these, we've got to figure out this gross product minus your direct costs, your gross margin minus your profit center overheads. And we're going to come up with that contribution margin. And then we subtract our business overheads. So there's 3 costs here. We've got our direct costs, our profit center overhead costs, and our business overheads. Let me describe those, why they're different. Your direct costs at the bottom, those are direct costs that basically get used up, okay? And they're usually on a per acre or a per unit basis. So in the livestock industry, maybe that's the hay, right? For every animal that you have, you need so many more units of feed or so many more vaccines. Or if it's on a crop side, then it's on a per acre basis, right? Every acre you have, you need that much more seed or that much more fertilizer or that much more whatever. Okay, so direct costs get used up and they're usually on a per unit basis, right? Every time you add one more unit of production, that will go up with it. So that's why we keep them separate. Now, your profit center overheads and business overheads are similar. They are costs that don't change necessarily with every unit, right? After quite a few units, they might go up, but not with every unit. The difference between them, though, is your business overheads cover the entire business, and your profit center overheads are specific to one profit center. Easy example of that would be the combine. Okay, the combine would be a profit center overhead. If you got, another 30 acres of grain land, you wouldn't have to buy another combine, right? You'd still use the same combine. Those costs wouldn't go up. But it's specific to just the grain profit center. You don't use that for the cows. You don't use that for the chickens. You don't use that for the garden. So what I want to do is penalize the profit center that equipment's for, or that labor's for, right? It could be labor as well, right? If that labor is working for that one profit center, that's where we're going to account for it. Now, your business overheads are for everything else, right? Your accounting bill, right? That covers all your profit centers because you've got to pay that accountant. Your power, your heat, your different things like that, they're all going to be under business overheads. So we've got direct costs, profit center overheads, and business overheads are different costs. So business overheads could be assets. I mentioned that the profit center overhead could be the combine. Well, an example of an asset in the business overheads could be your pickup truck, right? Your pickup truck goes to work in the grain operation. It runs to town to get parts and whatever. It can work with the cow-calf profit center, the feeder profit center. It can haul feed home for the chickens, right? It does everything. So it's going to be covered under the business overhead, as an example. We also have operations. So there's your power, heat, tax, bank fees and accounting bills and things like that. And we've got labor. Now, labor comes in two spots. Oops, I'm getting ahead of myself here. Labor comes in two spots. You can have labor in your business overheads, and you can also have labor in your profit center overheads, right? So I separate them out. If you're working feeding the cows, well, that would go into the profit center overheads. Whereas if you're doing your taxes, well, that's going to go in the business overheads. So I'm going to split my labor into a couple spots. So everything in blue here, I would call profit center number one. And like I said, we could have multiple profit centers. So we could have profit center number 2, number 3, number 4, right? It could add up. So here's I just expanded it out to show you that underneath each one of those profit centers, we would have that same little tree. It just gets complicated. If I put 20 of them on this screen, it would get way too complicated. Okay, so let's back up. This little tree is underneath all these. But if we're just looking at profit center number 1, that's what we need to see. And from here, all those profit centers combine to make a total contribution margin. Okay, I know this is getting complicated. I know I can see some smoke hovering above some heads there, but we're going to simplify this soon. We take our depreciation and our opportunity cost off of the business overheads and the profit center overheads. So that's where I said we're going to make sure we account for that. We've accounted for our labor. The only thing that we haven't looked at yet is inflation, and that's going to be taken off the profit at the end. All right. Whew, how's that for you? Is that complicated yet? I know this isn't the most exciting stuff in the world, but it is probably one of the most important things you could do for your farm. All right. I'm going to simplify it. For tonight, we're just going to look at this. We're going to look at one profit center, and we're going to take it to the contribution margin, and I'm going to combine it all together so it's not complicated. If you're a real keener and you really love this stuff and you dig into this, well, by all means, we can go further later and learn the whole gross margin analysis. But for tonight, we're going to keep it simple. I'm going to give you a calculator that's already does all the math for you. It's really simple, and you guys can plug in the numbers. It's not that complicated. Like I said at the beginning, it's really simple because it's a big number minus a little number. We just have to do it over and over and over, right? With all the different profit centers we have. So I'm going to give you some ratios because I have on the calculator that I have for you, there's one ratio on it, but I'm going to explain all of them to you so that the one will make sense, and a couple of bonus ones too. So I've got a gross margin ratio. That is the gross margin divided by the gross product. and I want it to be above 50%. Okay, so that probably means nothing to you right now, but let me show you. Under 25%, I'm not happy with. Over 50%, I'm ecstatic over, right? I love to get that. Now, economies of scale work into this too. This is just my benchmark. You guys can make whatever benchmark you want. If I'm looking for a 50% margin on my gross margin, but I sell 800,000 eggs in a month, right? I could make 1 cent profit on each egg, and I would make a profit because my economies of scale are so large, right? But when I only sell 30 pigs in a season, right, I need to make sure my margin's a little bit better. My gross margin ratio is better. So you need to adjust this for your operation, your economics of scale as well. So my benchmark ratios, I'll show them to you. You can adjust them and pick something that you think is right, but I'm going to show you why I pick 50%. So there's that chart again. What I mean by a gross margin ratio is my gross margin, which is right here, divided by my gross product, which is right there. That's my calculation. And what I want, let's simplify this. I want to make $100. If I made $100, I would like $50 in direct costs, and I would like $50 in a gross margin. Okay, so there's my 50%. For every $100 I make, I want $50 going forward to cover my profit center overheads. Okay, so that simplifies it. I also have another ratio. It's called my contribution margin ratio, and I'd like this to be 40%. So that's contribution margin divided by gross product. So let's go back to the chart. Out of that $100, I've got $50 going forward. Well, now I want $10 in profit center overheads, which gives me $40 going forward. Okay, so that's my goal. That's a 40% contribution margin ratio. Okay. Now, if I wanted to expand this, I don't actually in my gross margin, but to make sense of this, if I wanted to do a profit center ratio or a profit ratio, I would have my profit divided by my gross product, and I'd like to see it at 20%. So from that $40, I'd like to see $20 in overhead costs, which leaves me $20 in profit. Okay, so that's all this means. Pretty simple, but we just have it as a ratio. So out of every $100, I want to make $20 in profit. Doesn't seem too greedy, does it? The one that we're going to concentrate on though for today is this $40 one. Okay, my contribution margin ratio, I want 40%. And that's what my calculator that I'm going to show you is calculating. If I can make 40% on all my profit centers, there's a really good chance that I've got enough to cover my overhead costs. That's the simplified version of this to make that work. Okay. I also use what I call a rent ratio. This is a bonus one for you. In my situation, I'm a custom grazer, so I'd like to see a rent ratio under 30%. So this is my rent divided by my gross product. So to simplify this, if I could make $10,000 off a piece of land, I don't want my rent more than $3,000, right? That gives me $7,000 to move forward and cover all those costs. In your situation, in your environment, you might need to adjust that and change that. Those are just my benchmarks. If you want to use them, great. If you don't like them, no skin off my back. I will tell you though, I'm pretty aggressive, right? I set the bar pretty high. If you can't reach these, don't feel bad because I still don't reach them all the time. I love to have that mistake when there's more money in my pocket at the end of it. So I like to set my bar pretty high. Okay, so again, we're gonna look at this tonight. We're gonna look at our gross product, minus off some direct costs, and then we're also gonna, in the same calculator, we're gonna minus off some profit center overheads. And I'm gonna cheat a little bit. I talked about opportunity and depreciation, or opportunity cost and depreciation. We're gonna cheat, and I'm gonna throw some hourly rates at our equipment to make that easier. It's not perfect, it's not 100%. If you're a very precise person who has to know all the details, this might bug you a little bit. But I'm trying to simplify it so that, if it's not simple, people don't want to do it, right? You'll take this home and you think it'd be a good idea, and then you'll never get it done. So I'm trying to simplify things to make it so that you might actually take this home and use it. Okay, and again, that's what we're trying to solve. So I don't want to tie up the whole night with a boring presentation because I know this is so exciting. This stuff just makes you jump out of your chair. I know you're all just sitting on the edge of your seat, but you should be, because this is what we're trying to solve, right? I want to make sure that we can have a little bit of that money at the end of the day so that we can continue doing what we're doing. So yeah, that's the end of my presentation. And I'm going to turn it over to Johanna because she's got some breakout rooms or something we're going to go to.
Yeah, we're going to try a bit of an experiment. I'm going to set it up so that everybody's going to get sent to a breakout room. We're going to put some discussion questions up on your screen. Just some basic questions. How big do you think your average pasture unit is? Is it 100 acres? Is it 30 acres? How many cows can graze on that land? How many grazing days are there? That sort of stuff. So we're going to send you out to your individual groups to discuss those things, and then we're going to come back and we're going to play around with Steve's calculator a little bit with those numbers. So I'm just going to make sure.
Before they go, Johanna,
Mm-hmm.
So when you guys are answering these questions, don't be shy. Don't be afraid, because if you disagree with someone, I mean, we're going to use some human resource skills here. We don't want to get bitter. But part of the reason for this exercise is to show you that every environment is different. So if the average size of a pasture in your area is 50 acres and someone else is saying, no, the average is 300 acres, right? It's okay. It's okay to have different. What we're trying to get out of this is the average. So if you're disagreeing with what everybody's saying, that's perfectly fine. All we're trying to do is find an average. So if your average farm is 10 acres in size, then say that. I don't want you to be shy about it. If your average acre, pasture is 2,000 acres in size, say it, because we're going to try and get an average out of this, just to try and make it in the middle for everybody. So don't be shy.
Awesome. All right. So I'm going to send y'all to your rooms. I think they should automatically shut off after about 15 minutes. So have a good chat, and we'll see you in 15 minutes. I think myself, Katie, and Steve will probably be able to bounce around and see how everything's going, but we'll try it out.
See you on the flip side.
Yeah. We'll see if this works out here. There, I think you guys will get a little notification to join them. There we go. There, everybody's back.
What was the best room? Who had the best room?
I feel like you may be a bit biased there, Steve.
A little bit. A little bit. All right. So did everybody get some answers? Did we get some averages? Did we pick a spokesperson to be able to tell us this?
We got the opposite of an average.
Okay, what is an opposite of an average?
We had there was no average. It was between the few of us. It was 2 acre paddocks, 30 acre, 160, 160, 140. So there was a 5 in there. So basically, it was either average of 5 or 160.
Okay.
All righty.
Between 20 and 50.
Okay, so what I'm going to do is I'm going to share my screen, and I'm going to show you my calculator. A thumbs up.
You bet, Steve.
Looks good.
Yep. All right, so this is a very simple Excel spreadsheet. You guys are going to get a copy of this if you ask for it, or they already have it maybe.
We do have it. I will just drop the link to the Dropbox where you can download that in the chat here. If you haven't got it,
you can get
it there.
So this is a very simple spreadsheet. I made this up. It's not that complicated, but what it does is kind of covers all those things we talked about in up to the contribution margin. So it's including our direct costs and some of our profit center overhead costs. But this is specific to one profit center. This one is the grazing profit center. Now, you can easily change this and adjust it to any profit center. You just got to change some of the words, right? Now, on this calculator, this is the pasture or grazing version. Anything in yellow you can type in, and anything else you can't change, because I don't want, you don't want to screw up the formulas and not know what the formulas are. So in this version, it's locked so you don't mess anything up. So grazing or forages is very misunderstood, because most people don't buy or sell it, right? You have a pasture, you graze it, and it's consumed on farm. So not very many people understand the numbers behind it. They don't understand the yield behind it. You'd never take off a crop of wheat without knowing the yield that you took off. Well, people take off a crop of pasture all the time and they don't understand the yield. So we have to figure that out. And the way I set this up is that everybody is a custom grazer. Okay, it's a profit center. It's no different than someone who makes hay. Okay, so if we break this into profit centers, we've got, let's say we've got a landowner who owns the land, we've got a hay producer that makes hay, and we have a cattle owner that buys the hay. Okay, those are three distinct profit centers. You don't have to do all of them. You could just do one of them. You could be a landowner, you could be the hay guy, you could be the cattle guy. So grazing is no different, right? You could be a landowner, the custom grazer rents the land from the landowner, and the custom grazer charges the cattle guy to graze on his land. Okay. Now, when you do a gross margin analysis on a grazing profit center, the decisions you can make out of that is: one, should I graze my own cows? Two, should I graze somebody else's cows? Three, should I send my cows to somebody else to graze? Okay, it comes down to an economic decision. And if you do the numbers, all of a sudden those decisions get really easy. And one of the big breakthroughs on my farm years ago was I owned a herd of cows, but I didn't have enough cows to cover my land. So I learned how to do a gross margin analysis, ran my custom grazing profit center, ran my cow-calf profit center, and I found out that my cows were losing money. And I'm like, what? I had really good calving rates, good conception, I mean, very few death losses. I think we had that year we had a few sets of twins. We ended up with a 103% weaning ratio, right? Like we were bale grazing for 60 cents a day. We were doing this rotational grazing and the grass was growing really good, right? We were doing great, but we were losing money, right? Why couldn't I pay the bills? So when I did the numbers, it worked out that my cows were losing money because I was paying too much for grass. That was my highest cost, was my pasture management, and it was my grass. It didn't make any sense to me, but I started crunching those numbers and it's like, well, the opportunity is that I can charge, at the time was $1.25 per cow-calf pair per day. Well, that's the opportunity rent or the opportunity cost of those grazing those animals. So I had to charge that to my cows. So it was the most expensive part of my cow profit center. And it was what I was having to pay myself. The opportunity was I could get that from somebody else. So when I worked out the numbers, I was losing money on my cows, making money on my custom grazing. When I got rid of my cows, I stopped doing something. I made more money because that gave me room to bring in more cows from somebody else. And I made more money. Okay, so that might not necessarily happen in your environment, in your situation, but that's how how it makes the decisions easier, because all of a sudden something just jumps out at you. Now, that doesn't mean it's going to work the same for you. Let's say, or it might not stay year after year the same way. Let's say that the demand for custom grazing dropped, right? I'm going to use the same numbers. I actually make a little bit more than that now because that was 20 years ago. But let's say that demand for custom grazing dropped, so I couldn't get $1.25 anymore. Let's say it dropped to 80 cents, right? Unless I dropped my price to 80 cents, I wouldn't get any cows. All of a sudden, the margin on the cow profit center looks better, because all of a sudden the cows are only paying 80 cents for grass instead of $1.25. So at that point, maybe I'd buy more cows again. But at the time, that was the situation. That was the numbers that we were working with, and it made the decision really easy. So I sold the cows and I made more profit. Okay. So the decisions you have to make is, again, should you graze your own cows as a custom grazer? Should you graze someone else's cows, or should you send your cows to someone else to graze, right? Those could be the decisions out of this. So what we have to do is set this up, pretend you're a custom grazer, and wear 3 different hats, right? There could be a landowner, there could be a custom grazer, and there could be a cow owner, okay? You might do all 3, but when we're doing the numbers, we're looking at 3 different hats. So on this page, we're only the custom grazer. Okay, you got to remember which hat you're wearing. So from our little breakout sessions there, I wanted you guys to kind of come together in some kind of average of your area. We had quite a variety in our group, right? We went anywhere from the average farm or the average pasture size was 40 acres in size up to about 320, right? So we came up with an average pasture size of 160 acres. So anybody else want to volunteer from each group of what was the average size of a pasture you came up with in your group? You can type in chat if you're really shy.
Group 1, we had some wild outliers. So let's go with 25 acres.
Okay, so that was the average size of the whole pasture, or was that per paddock? Just to be clear.
We'll say per paddock.
Okay, so what was the average size of the whole pasture? Or did we?
No, I'm sorry, per pasture, not per paddock.
Okay, so 25 acres. Okay, group 2. Joanna, can you keep an eye on chat in case somebody's shy?
Yes, I can.
Awesome. If you want to cheat and just everybody start typing it in chat from your groups, that's fine too. If you're too shy to turn your video on or your mic. I'm not that scary. I like it when I can see people.
We got 20. Group 8 was around 140, 15, 160.
Group 6 was about 30.
Don't remember which group they were in, but around 130. Group 5, maybe 45 acres. Group 7 was 160.
Well, right away, I remember that it was group 7 we were in because that was the best group. Okay, I'm trying to get kind of an average here. We're looking at an average, maybe about 100, maybe 80 acres. Let's go 80 acres. Okay, so that's where I'm going to put this in the chart here. 80 acres right here. Boom, and nothing else calculates yet because we have no other numbers in here. So on that 80 acre pasture, how many cows could you graze on that for a season? Did you guys talk about that? So if you had 160, you got to cut it in half. If you had 40, you got to double it. Same thing. If you want to just type it in chat, that'd be great. Okay, so 23. I don't think we got there.
That's fair enough.
That's okay.
40. 27. 26.
Yeah, we had to cut our group 7. We had to cut ours in half because we were double that. So
Group 9, 3 pair an acre.
3 pair an acre. So we are at 80 acres. Anybody else? What are we doing? 3 pair an acre.
I think theirs was about 2.8 acres per pair. 1 pair per 3 acres. Yeah, 3 acres to a pair was that first
28. One. Yeah, the one was the other way around. So one's really high. That's about 240. The other one is 28 for 80 acres. Is that 240 correct? Where are you guys at? You're way down south, or you got lots of rainfall?
No, he was thinking they got it switched around, so it was 3 acres to the pair.
Oh, okay. Okay, so that's about 30 again. Okay.
Yeah.
It's possible though. That I've done this in actual live sessions. I think I was in Ontario one time. We had anywhere from I just top of my head I remember the land rent part. We had anywhere from $25 an acre to $300 an acre in the same room, right? And they were 30 miles apart, just because the land changed so much. So all of this can change. Production can change in a wet area to a dry area. And normally that's because we're in a room in a certain location. Right now we're in a Zoom room where we could be anywhere. So this variation could be even more exaggerated. 3 acres per pair. Group 5 is 30. Okay, so we're sitting there, average there about 25 to 30. Let's say we're at 30. I'm going to give you guys a benefit of the doubt here. Okay, and did you guys discuss how many days that was? Because if you have a 100-day grazing period versus a 180-day grazing period, it makes a big difference. So 80 acres, we had 30 animals and days on pasture. 150, 120, 150. We're looking like 150 average, a little bit less, maybe 140, 100 to 180, 160, 150. Anybody opposed to 150? That seems like a common one. About the middle. So from there, in your area, this one we're going to do kind of live. You can type it into chat if you want. In your area, do you know what a custom grazing rate is? Okay, if you were to send your cattle to somebody else and they did all the management, how much would you pay per cow? Or if you were to bring animals in, how much revenue could you get per cow to custom graze somebody else's? Now, some areas don't have custom grazing. Maybe you can't answer this one, but if anybody has some insight from your area, I'd like to hear it. I can start my area right now. I get $1.50 per cow-calf pair. That depends on the size of the cow. If it's an 1,800-pound cow, I might bump that up a little bit. If it's an 1,000-pound cow, I can drop that a little bit. But right now, that's what I got this summer was $1.50. So what are you guys getting?
Lots of input. Someone says 75 cents, 160 to $2 a pair, $1 per head or $1 per pair, 140 per pair per day, 130 per pair.
Now remember who's doing the management. If you were to rent a piece of land and you had to go take care of your cows, that's not custom grazing. Okay, that's just renting land and then you do all the work. If you're actually custom grazing, you send your cows to somebody else and they do the work. So that's a bit of a confusion some people have is who's doing the work out of this. So if it's $2, I'm out of cows. I like that.
$19 per month per pair.
Oh, 25 cents per day per sheep. Okay, times it by 8. Some people say 7. A sheep or a goat equivalent, they say 7 or 8 sheep will equal 1 cow. So maybe that's a way to make that one equivalent.
75 cents a day. Said they did the work, but they supplied the mineral.
Okay, so what's an average out of this? 19 per month. So that's less than $1 yet.
There's one that's $1.25.
Okay, so are we going to be safe to say $1 or $1.10, or because there's some above that, but there's lots of dollars. There's a few below it too.
Yeah, that sounds.
$1.40, $1.30. Let's do $1.20 just for fun. Everybody okay with that? If anybody's drastically opposed to that, we're going to do $1.20. Okay. So everybody see that? We've got a gross revenue now, $5,400. We had 30 animals grazing at $1.20 per day for 150 days on 80 acres. So that's what we put in so far. So what number is that one? That's supposed to be our big number. Remember that. Let's make sure this is our big number. Okay, now we got to work on the little number. So let's look at some grazing costs. Now I've got a whole bunch on here because every farm's different. You guys can throw this in yourself. If you add seed every year, you might put a value in there for that. If you do fertilizer, you have a spot for that. Equipment costs, right? Maybe if you're going to charge for the act of seeding or the act of fertilizing, you're going to put something in there. Trucking, maybe there's a trucking cost. Remember who owns the animals and who doesn't. So in this situation, the trucking might not be actually moving the animals in and out, because as a custom grazer, the owner of the cattle pay for the trucking, right? That's not my cost. But I might, maybe I've got a pasture split into two places and I'm going to move them across. Well, then I might have a charge for my trucking, because I'm any moving in between might be my cost. Or in this case, maybe it's trucking to go get the fertilizer or to go pick up the seed. You could throw that in there. Rejuvenation costs. That would be similar to our water systems and cross fencing that we're going to go through. When you first rejuvenated that land, seeded it down, it probably cost you quite a bit. But that's a 1 year cost. On year 2, 3, 4, or 5, you don't have to pay for that. So you might want to amortize that out over a few years, because you don't have to do that every year. And that's what we're going to do with the water system here. So we got you in the breakout rooms there to think about a water system, what's normal in your area. Like a lot of people, I know in our group, a lot of people, normal in the area is for them just to let them walk into the dugouts or drink out of the creeks. But if you were to put in a water system, what would you put in? What did you guys come up with? And what would be the cost of that, right? What's the average cost to buy that water system and get it set up? If you want to say it out loud, great. If you want to throw it in chat, that's fine too. I see 3,000 to 7,000. PCBA rents a solar unit for about 500 a year. You can actually use it for the whole year for 500 bucks. That's cool. Solar was 8. Solar was 2,500. Yeah, I think we ended up coming up with 2,500 too. We had some lower ones and then one bigger one, so we averaged 7,000 for a pressure system. 1,000 bucks, 13,000. Oh, new dugout.
And a year-round water system, that'll do it.
60 grand. All right, so our costs are pretty high, right? Now, the difference is between economics and finances. We talked about this before. Financially, you got to come up with that value on the first year. But year 2, 3, 4, 5, 6, and onwards, it's already covered, right? Maybe you had to get a loan to do it. Maybe you had some other money from somewhere else to get it going. But so what we're going to do is amortize this. So I'm going to put this, whoops, sorry, put this in here. Water system. What was the average out of that? Joanna, what do you think? 4 grand, 5 grand?
Let's go, yeah, five grand or so. Lots of people talking about putting in dugouts and stuff too. So
yeah, so cost, let's say average 5 grand. That's maybe your water trough, your pipeline, or maybe it's your solar system with a trough. Now that water system, how many years is it going to last you? Is it only going to last you 2 years, or is it going to last you 5 years, or maybe 10 years? What do you guys think?
hopefully
I see 15 years. Yeah.
20 years, 10 to 15, hopefully 8 years, 15 years.
Well, now they're coming in. Look at that. Everybody's quick on the ball now. This is working quick. 10, 10, 20, 15. So I'm looking at an average of about 15 years there by the looks of it.
Yeah.
10 plus. Let's go 15. Okay. So I'm going to amortize that over 15 years. And I also divide that by the number of acres. Okay, so this 80 acres that we already put in, that's automatically going to divide out here. That's why this little subcalculator over here. So 5,000 divided by 15 divided by 80 ended up giving us $4.17 an acre over the 15 years. So doesn't seem that expensive now, does it? That's the economic side. But if we're looking at a financial side, we had to come up with 5 grand on year 1, right? That might be hard to do on that first year. So that's where you need some money from somewhere to get things started, whether it's through a operating loan or a loan of some kind, or you've got money from some other source. Now, we were talking about this before everybody got here today a little bit. When I got started, I had to get some money from somewhere. I was actually driving a truck to set up my first quarter, right? You have to have something from somewhere. Then I got another one set up, and then I got another one set up. And then once you get going, now we start making some profit off of the lands that are set up because we've already paid those costs, right? And now you get to keep that money out of it. So I take some of the profit from the land that's set up and I set up another one, right? And then I take some money out of the ones that are set up and I set up another one. So it's a difference between economics and cash flow. So we've got to run two sets of books. But economically speaking, that water system is not that expensive, just over $4 an acre. Okay, so it's well worth it in my mind as a custom grazer to put in a water system. It's pretty cheap. Okay, we're going to do the same thing with fencing. If we have an 80-acre pasture, how much does it cost to put in our cross fencing? If we're going to do some rotational grazing, ballpark, you can throw it into chat. What do you think it's going to cost? I'm going to cheat a little bit here. Years ago, I did a calculation and I figured out that it cost me about $1,000 per mile to put in a cross fence, right? That's labor and equipment and the materials, the wire, the posts. So we can cheat and just use that number, but how many miles of cross fence are we going to need on 80 acres? Is it 1 mile, 2 miles, 3 miles?
Is that electric or?
What would you guys do in your area? What would your cross fencing be if you're going to do some rotational grazing? Is it just a 1-wire electric? Is it 2-wire electric? Is it all electric netting? Or do you put up a 4-strand barbed wire fence?
$5 a meter all in for page wire.
Yeah, that's going to change your fencing costs, isn't it? If you've got to use goats or sheep or something for page wire, it's going to change your economics. 2-wire electric, 3-wire electric. Okay, so everybody's telling us what they're doing. So how many miles on 80 acres? So just for a reference, if I was to do 16 paddocks on a quarter section, okay, so if I was to do a double alley system, break 160 acres into 10-acre paddocks, there's 4 miles of cross fencing on a 160 acres. Okay, I've done the math on that one. So if this is 80 acres, so you cut it in half, if you were to do 16 paddocks out of that, maybe it would be 2 miles of cross fencing. If you're only going to do 8 paddocks, well, then maybe we've got a mile of cross fencing. So
3-wire at 35 cents a foot.
You aren't counting for fence line clearing. Yep, you're right. If you have to do fence line clearing, that's going to cost some more. But this is the initial setup, putting the fence in. We're still going to manage and deal with some of these fence lines after, but this is just the initial cost to put it in. No fence system. I've been bugging our research association for years to get a no fence system on trial here. So I'm still working on them. So 2.5 to 3, 4 miles. What else do we have? 2 miles. So I think so far, anybody want to get a last measurement in? I think we're looking at 3 miles of fence. So I'm going to say that $1,000 is going to be $3,000. And compared to your water system, how long is that fence going to last? If you're using poly wire with step-in posts, I know the wildlife can get pretty hard on those. To me, they last between 5 and 8 years. If I'm using wood posts and high tensile wire, they could last 20 years. So what do you think? How many years are we going to amortize this for? Yeah, poly wire and ring posts, 5 years, 25 years, right? It really depends on what material you're using. So 5, 25, 5. Anybody else? 20 for high tensile. So far, I'm going to go with an average of about 10. Oh, another 25. So let's bump it up to 15. Okay, doesn't really matter. You get the point. So that works out to $200 per year, which down here divided by 80 acres ends up being $2.50 an acre. Okay, so cross fencing really not that expensive in the long run when you're looking at an economic basis. To begin with, when you're setting up that property, yeah, it costs you $3 grand out of your pocket. Okay, that's the finance side. All right, another thing I'm going to look at is spring setup labor as a custom grazer. So every year I have to go out and check a perimeter fence, and I've got a lot of bush, so I got to, definitely take a chainsaw with me. I have to run around the pasture, cut off the trees, fix the wire that the moose ran through, the deer broke, or the hunters, or the quadders, or whoever cut my wire. I have to fix all that stuff. So I have to get my electric fence set up, get the fencer there and the battery and whatever. I have to set up my water system, haul it in place, get it running, get tanks filling, whatever I have to do. How long does that take? If you had a pasture that was 80 acres in size, you were going to be grazing 30 cows for 150 days. How long would it take you to check that fence? Perimeter fence, cross fencing, set up your water. Is it a day? Is it 2 days? Is it 3 hours? What do you think would happen? $2.5 days, couple of days. Now, is your day an 8-hour day? Or is it to go out and took you 2 hours and then you went somewhere else for the rest of the day? Martin says 5 hours, 8 hours. So I'm going to go, if you said 2 days, I'm going to say that's 16 hours. Is that fair? 20 man hours. Oh, 20 man hours, probably only 14 woman hours then, right? Because they're way more efficient. 80 acres at 8 hours. 80 acres. Yeah, for 80 acres.
A day including coffee break. That sounds right.
Yeah. Oh, Lynn,
Yeah.
Lynn, I had toddlers with me too. There was always a car seat in the back of my bale truck, I tell you. I know what that's like. Okay, so I'm going to say that averaged about 8 hours. Now, were you on foot or did you have a piece of equipment with you? Because we want to account for the opportunity cost and the depreciation on the equipment you're using. So this is where I'm going to cheat. Instead of actually working that out and breaking your piece of equipment down into all its fuel and repair costs and insurance and all those things, we're going to give it an hourly rate as if it was a custom piece of equipment, as if you hired that in. Or if you had a horse, I see that there too, Louise, a horse. What does that piece of equipment and the manpower worth on an hourly basis? So with your side-by-side or your quad or your pickup truck, do you need a tractor and a post pounder, right? Just to get that checked, what is it going to take? $60 to $80. So this is a per hour rate. I like to compare it to other equipment in other industries. Let's say if you had a tractor out there running, would that be equivalent to somebody who owns a backhoe? And I know I can hire a neighbor here of a backhoe at $125 an hour. Now, you're not going to have to pay that much for a pickup truck or a quad, but somewhere in there, what's the value of the equipment and the operator? $100 a day. So divide that by 8 hours. Man 20, quad 30. Yeah, that sounds about right. So 25, okay. So are we fair to say $40 to $50 an hour for both? 25 for the pickup, but you also have the person. How much is what do you pay a person? Man at 25 side by side. Could be about the same. Is it fair for me to say $50? I think that's what I'm getting out of that. Okay, so what that does is shows us our 8 hours of labor at $50 is $400. And then over here, it divides it by the 80 acres. And we ended up with $5 an acre for spring setup. Okay. Now, kind of a big one. Let's look at grazing labor. Do we continuously graze? Or obviously we put some fencing costs in here. We're going to do some kind of rotation. We have to figure out how often we're going to go down there, how often we're going to move. So how much labor it's going to cost and how long it takes us every time we do that. So picture yourself going to check this herd. From the time you turn the key on, go out there, check the herd, check the water, move the animals, check the mineral. You know, maybe once in a while you might have to treat somebody or do something extra. What's your average time that you spend checking that herd one time? If it's 50 miles away, it's going to be a lot longer because there's drive time. If it's right outside your back door, right, you might be able to do it in 15, 20 minutes. So what's kind of average? What do you guys think in your area? What do you do? 20 minutes, an hour? Oh, I missed the case of beer for the man. That was good. I like that one. Although I can't drink beer.
At least an hour, 30 to 45 minutes. Hour if nothing's wrong.
I'm thinking an hour is going to be our pick here, right? Maybe 45 minutes. Okay, let's go with a lot of hours and some 20 minutes in there. So let's go with 45 minutes. Oh, by the way, I did this last one wrong. I'm going to go 8 hours, 8 hours. We did 25 and 25. It adds up the same, but just to be clear on there. Okay, grazing labor. So if we do an hour, no, I said 45 minutes. So 0.75 of an hour. We're going to use the same rate, 25 for the person, 25 for the equipment. We can still do that at 50. Oh, and I did that the same way here. I should do the same thing. Just to break it up. Okay, so we ended up with 37. That one's not supposed to be there yet. We grazed for 150 days. So how often do we go check? If it takes us 3/4 of an hour or 45 minutes every time we go check, how many days of the season did we go down there? Do we move every day? So that would be 150 trips. Do we move every second day? Then it's cut that in half. So out of 150, how often do we move? Twice a week, I see. Daily moves every day. A lot of daily moves. Bonnie, you're moving every 3 days by the looks of it. Once a day to twice a day, daily. 2 to 3 moves a week. Once a week. So a lot of daily moves in that. Can we average that at every second day? Is that fair? Just for argument's sake here. Let's move that. So that would be 150 days. We're talking 75 trips in a season. And you know what? Just because I know once in a while I'm going to lose my hammer or forget something and have to make 2 trips in a day, I'm going to do 80. I like to err a little bit higher than what we do because you know you're never going to have it perfect. You're never going to quite get everything every time. Or a water pump's going to be broken and you got to run home an extra time to pick up another water pump or something. So, okay. So that's 80 trips at that. We end up with a total cost of $3,000. Grazing labor divided by 80 ends up with $37.50 per acre. So what's your biggest cost in a custom grazing operation so far? You're moving. Okay. So here's my argument. I've been using it, saying it for years. There are people who talk about doing very high stock density grazing, and there's people who continuously graze. Okay. Somewhere in between those 2 points is the economic threshold for your farm. Okay, and you need to decide that, because $37.50, that's the most expensive part of our grazing operation so far. Okay, so you can't do what somebody else does. If you see somebody doing very high stock density grazing, well, they might have different circumstances than you. It might work for them, or they might not know their numbers, but it doesn't necessarily mean that's the way to go. The higher the stock density, the better you are at healing land, and you're going to get better production out of the land, but at what cost? Okay. Let's do one more. What's the average land rent in your area? So if you had to go out and rent an 80-acre piece of land, what would the average land rent be? Let's do it on a per acre basis. So in my area, I rent something anywhere from about $5 an acre for bushland, upward of $45 an acre. Actually, one piece of land I pay $60 an acre. I don't know why I pay that much, but I do. So that one's a mistake, but I'm experimenting with it. Okay, 25, 35. Well, these are coming in fast now. You're way ahead of me. Joanna, what's the average there? They're getting ahead of me.
Oh, that's a good question. Seeing lots between
350 to 450
and 50.
350 to 450. Ouch.
Oof. Well, there's one that's 15. A lot of 30, between 30 and 50 is a lot what I'm seeing.
So really good example though, to have that 350 to 450 in there.
Yeah.
It's going to change your margin, isn't it? It's really going to change your margin. So that's going to be the deciding factor, whether you graze your own, you graze somebody else's cattle, or you send your cows somewhere else to graze, right? That's going to make that decision easier. Okay, what do you think the average is there?
I think we got to go up to like 45 or 50 maybe.
Okay.
A couple places, everything's cropland around here, 120 to 150. Yeah. Okay. That'll do it.
I'm going to go 145. Now, we're not renting. This is a pasture land. We're not renting cropland here, right? Hopefully it's pasture land. So it should be equivalent, a little bit lower. Cropland, don't see much grass. So just for argument's sake, I'm going to throw 45 in here. We're going to play with it anyway. There's a spot here for if you have pasture insurance or drought insurance, you can throw that into. And there's a couple of blank lines for something else that we haven't thought of. But we're going to leave it at that for today, just to see what's going on here. Now, we had a big number at $5,400. Okay, that's our gross product. We moved down here and our total cost ended up being $7,500. We have a negative contribution margin. Okay, negative $26 an acre. Our contribution margin ratio is negative 39%. I'd like to see that at 50%. And our rent ratio is 66%. And I'd like to see that less than 30%. So what decision would we make out of this pasture? We're not making any money at it, right? We've got a little number minus a big number and we're losing money. Okay. So there's 3 ways to make more money. Number 1 was to make the big number bigger. Okay. Number 2 is to make the small number smaller. Third one, if those are working, was to do more of it. So right now our margin's not working. We need to fix it. So let's do some brainstorming here. This is our big number. How can we make that bigger? Can we graze more animals? Can we get a higher revenue? Or could we get more days? Okay, is that possible? Could you switch and graze some organic animals? Could you switch and maybe you could put some fertilizer on it and get more production out of it? Okay, but we've got to also weigh that into our costs as well. Could you bale graze across part of this and bump up the production, right? How can you trigger this to kick it into gear, right? I'm not saying I have any answers for you here today for this situation, but what can we do to change this? Okay. One of the things that I do on my farm, because my market values might be different than yours, but yearlings pay better than cows. Okay, a cow-calf pair will eat twice as much as a 700-pound yearling. Okay? I can get, let's say if we can get $1.20 for a cow-calf pair, well, I know I can get 80 cents for a yearling. So if you doubled that, that'd be $1.60 in animal units, if you can see that. So if we were to change that, I get twice as many animals. So remember this, we're at 5,400. If I change this to twice as many animals, so 60 yearlings at 80 cents, we're now at $7,200, okay? Now we're almost breaking even. Okay, so maybe a class of livestock could change. Maybe we can adjust something else, bring in some bred heifers, and maybe we could get 90 cents for them or something, right? So now we can start to play and make some decisions and see what we can come up with. Could we look at the other part of it now and make the small number smaller? Do you think it would do us any good to lower the value of our water system, right? $4. Pretty tough to beat that. If we took away the water system and let them walk into the dugout, well, now we're getting hoof rots, and now we're going to have more treatment time, which means our labor is going to go up. And you can already see our labors are one of our biggest costs. So I don't think we're going to save money by cheaping out on a water system. Same with the fencing. We're not going to get more production if we get less fencing. Okay, so there's a balance here somewhere we have to find. You could try it. You could put this whole thing as a continuous graze, throw out, instead of, sorry, let's go back to 30 animals and $1.20. Okay, so you could go back to continuous grazing and maybe put 20 animals out there and see how the numbers work with very little labor. See how the numbers work. Spring setup, think we could cheap out on that a little bit? Probably not a good idea, because then they're in the neighbor's canola field, and that'll be more labor. So I think our grazing labor is the one that we can play with, or rent. Those are the two big ones. Could you go out and negotiate with your landowner and use some human resource skills and get your rent lower? Okay, I've done it. I've showed pictures of dung beetles and talked about ecology. I've talked about, I brought in put in a shelter belt for the landowners, hunting rights, hunting privileges, you name it. What does that person want? I've said it before, human resources is the most important part of my business. It's not grazing, right? If I don't have the land to graze, doesn't matter how good of a grazer I am. So is there some way to manage that land rent? If we could drop it to $40, okay, we're getting closer. If maybe we need to change our grazing rate. Okay, what if we decide, okay, moving, what did we do? Every 2 days, I think? What if we back down to moving twice a week? Okay, and then maybe we drop this down to 60 trips. I'm just guessing at that. But it drops our grazing labor to $28. Okay, we're getting closer. So again, there's an economic threshold on every piece of pasture. Right? When I had a pasture 25 miles away and it was 200 acres, I only went down twice a week. Right? I didn't graze it as intense because it wasn't worth my labor and equipment cost to go down there and move 100 yearlings. I added to that pasture. I added 4 more quarters to it. So now I have 1,100 acres down there. Now I'm running 600 head down there. It's worth my time to go down every day because my labor and equipment divides out a lot better with 600 head than it did with 100 head. Okay, so that economic threshold changes depending on distance. It depends on the size of the herd. Depends on the amount of work you have to put into it. The good thing about that pasture is my perimeter fences are fantastic, right? They're really good perimeter fences. We drive around them once, they're usually good. The owner had a cat, he's cleared all the fence lines. You can't quite drive around all of them, but usually there's very little repairs on that perimeter fence. And cross fences are pretty easy, it's mostly open land. I've got another pasture where the back bush, there's a 500-acre bush, it's a walking check. And if you need posts, you're either hauling them in or you're making your own out of trees that you cut down. So you're carrying in a chainsaw and making your own. So that one is a lot more labor involved. that makes a big difference on whether this margin is going to work or not. So other than that, that's my pasture calculator. If anybody has any questions, do you guys want to play with this some more? You want to add something else? How else could we make the big number bigger or the small number smaller? If anybody has any ideas, we could easily play with it.
Sue says add another species.
Yeah. I've been wanting to add another species on my place for a long time, but I have all leased land. And if I add a species, the problem is the fencing, right? We've got a lot of acreage owners. I'm always right by the highway. The dilemma I have is the fencing. I'm not going to put $30,000 into page wire around a piece of land I could lose next year. So yes, if it's your land and you've got good fencing, definitely. Adding sheep in with cows or goats in with cows, that virtual fencing would come in pretty handy there. You could keep the goats with the cows a lot easier that way. Extend the grazing season, yeah. How could you extend the grazing season? If you bale grazed or if you put fertilizer on or somehow improve that, you might get more. But if you lower your number of animals, you might get more days. Or if you increase your number of animals, you get less days, right? Without changing the production, that's not going to change your margin. And the longer your grazing season, now this comes from a custom guy, the longer your grazing season, the more labor you put into it. If I've got a certain amount of grass to sell in a season, I would much prefer to sell that grass in 5 months worth of labor instead of 8 months worth of labor as a custom guy. If you own the animals, you're going to be better off to graze as late as possible because you're saving money on feed. But if we're just looking at a custom grazing operation, extending it doesn't necessarily mean you're going to make more money because you're only going to grow so much grass. Now, there's other reasons. There's human resources. I want to keep my customers happy and graze as late as I can. But yeah. What if you add pasture poultry? Yeah, if you added in another profit center, now you've layered profit centers. Now your grazing labor will divide out better. Okay, I do that with my pasture pigs, right? The pasture pigs are on the same pasture as my cow herd. We've got 1,100 acres that the cows roam around, and then I've got a 9-acre field that the pigs roam around. So when I drive down there, right from my home, it's probably, I'm going to say 7 miles. Now I have 2 herds to manage there, not just one. So we divide out that labor a little bit more. Any other questions there in chat? I'm just going to snoop through them.
Question on calculator setup. Have to be per pasture, otherwise you don't get the indicators for each piece of land. So if you have a lot of pastures, does it get kind of cumbersome?
So I do this on a pasture to get my head wrapped around the whole cell. Now, when I actually do my grazing chart, which is another spreadsheet, and I don't mind giving that one out too if anybody wants. I'll make you work at it though. You have to email me and then I'll send it to you. Then in my grazing chart, it breaks down every field or at least every area. The chart only has 30 paddocks. So if you end up having 50 paddocks, you have to combine a few of them to make it work. But 30 was my maximum on the chart. But if I have, let's say I have a quarter section, part of it's bush, part of it's open, right? We got 2 bush paddocks and we've got 3 open paddocks. Well, I just put them as the bush and the open. I know I graze the open land in 3 different paddocks, but they're about the same production. So when we're trying to figure out a margin on that, it still works out if you've only got 16 paddocks, then you're fine. You can put every paddock in there. Okay, what else are we doing here?
Quick question. Do you hire out your time or for one-on-one, or do you have someone you know that does?
Just like as a webinar or a consulting, yes. I've got a few different webinars that we can, same thing, it's a one-on-one Zoom call. I do on farm as well, but with COVID, that hasn't been very many lately. But yes, I definitely can do a one-on-one session for you.
Another one from Scott. You have an 8,000 capital expense with fencing and water. So can you talk about making less this year and more next year? And Scott, we might get you to come off mute and clarify a little bit.
So maybe do half of it this year and half of it next year, or I'm not sure quite what you mean by that. I'll start on that. Maybe this is what he's talking about. When I first started, I kind of took baby steps because I didn't have the cash flow for it. Well, once I got to figure this out, it was well worth it for me to put the money in and get it done right away. Okay, so my fencing is my number one priority because I have to stop the overgrazing. So if I can get, in my world, I like a minimum of 16 paddocks per grazing cell. And it's kind of a minimum for me. I've heard people say 12 or something like that. My magic number is kind of 16. I'll tell you right now, all of my pastures have more than 16 paddocks, but as a starting point, 16 would be my minimum. I'll get that in right away, even before I spend a bunch of money on water systems or something. I'll, do the bare minimum, get that overgrazing stopped, because that's my number one. If I slow down and try and cash flow it and take 3 years to get those paddocks in, well, I haven't stopped overgrazing, so I'm not going to be moving forward near as quick. So I've figured out with my situation, it's well worth me to get that fence in right away. Okay, a 1-wire electric fence is not that expensive. Even if you had to do part of it the first year, like if I did 8 paddocks that are permanent, but I didn't have time to get them, well, then I can do the other, split everyone in half with temporary wires. I still got my 16. And I might do that on purpose sometimes because I want to get more land with it. If somebody gives me a quarter land, and right away for a custom grazer, I'm like, I'd like to get a little bigger because I need more animals to make my time and labor divide out better. So right away, I'll start looking for land around it, right, to try and add to it. So maybe I put in 8 paddocks, and then the first year use some temporary fencing to make that into 16. And then hopefully by next year, I found another quarter to go with it. Now I put 8 in there. Now I've got my 16 total. Right? Because the very first quarter I ever started, I remember it took me 2 or 3 years to set it up, but I ended up with 24 paddocks on 1 quarter. Well, then I expanded, I got bigger, and I added land to it. And then I started taking fences out. And as of right now, today, that same piece of land, there's 1, 2, 3, 4, 5 paddocks on it, not 24, right? Because the herd's bigger. If I left it at 24, I'd be over there moving 3 times a day because my herd's a lot bigger than it was when I started. So, there's baby steps to take, and you can take steps into it, but my goal is to make sure I get that minimum number of paddocks so I can stop overgrazing. I don't know if I answered your question, Scott.
In the meantime, we got.
Hey, can you hear me there? I apologize. I know a fair amount about calcium and nothing about computers. And I bought some new wireless headphones that every time I hit the wrong button, it hangs up on you. So outside of frustration, here we go. So my question is, you have a $8,000 capital expense going into this year up front. So you're on a negative cash flow. And I understand that we don't want to be in a negative cash flow, but next year we're not going to have the $8,000 expense in the year after the year after the year after. And unless I read that wrong, won't you make more? I might get to hopefully a break-even cash flow this year. But how is that going to affect us in year 2, 5, and 10? Does that make sense? And I could have understood it wrong, but that's my question.
Yeah, well, that's exactly why we amortized it in that calculator. Okay, we divided the fencing and the water out over 10 years or 15 years because I want to see the economics behind it, right? If I looked at it on a financial part or a cash flow point, yeah, that 8,000, I got to come up with it somehow. Now you could get a loan. Right, you could get a loan and then you would be paying that, $4 per acre per year, but now you've got an interest charge on it. If you had the cash up front, well, there's still an opportunity cost on that cash, but you put into that water system. If we did a full gross margin analysis, we would take opportunity cost and depreciation off your water system that you bought as well. Okay, but I tried to make it simple here today with that calculator. So yes, that's exactly why we did it. It's the difference between economics and finances. Exactly what you explained.
Okay. Well, thank you. I appreciate that.
Yep.
I have two similar questions from Janelle and Greg, wondering how do you account for soil creation, biodiversity, etc., especially if it's your land? And yeah, just wondering about soil improvement. So it must be worth something making my time and labor more profitable.
Well, it should increase your production over time, right? As you improve your land, your soil, your biodiversity, your production should go up. You should get, your big number should get bigger, right? So that's where that comes in. If we've got, what do we have, 30 cows grazing on that for 150 days, maybe you don't get to increase the number of cows, but maybe you get more days out of it because of your management, okay? Now, there's another side to that too. If you own the land, maybe your value goes up because it's in better shape. Because I know in my land that I manage, somebody else owns it, but their land has gone up in value because all the grain farmers want to buy the land out from underneath me. In the last 20 years, I've lost 9 quarters of land to grain farmers that really want to get a hold of my land because I've built it up. It's in great shape. I've had agronomists come out, take samples and tests, and they said we've never seen such high quality land. And I'm in a gray wooded soil zone. If anybody wants to take a peek, I just posted on my Facebook page a while ago. We went and dug some holes in a zero till field that's been zero till for 15 or 20 years, right? It's the peak, the best management in grain farming. And they're 10 miles down the road in the black soil zone, right? That's the good land. I'm over on the west here in the gray wooded soil, right? Developed under leaf litter, not very high quality. I'm in cow country. And you take a look at those two different soil profiles because we dug holes in both of them. I've got this rich black topsoil, right? Gray wooded soil. I got this rich black topsoil between, I think about 4 inches and about 16 inches deep, according to the soil test reports. And we went over there and dug in this zero till field. We couldn't tell the difference between the clay color and the topsoil color. Right? I told the guy digging the backhoe, I said, okay, let's dig the topsoil. We were looking at roots, by the way. We were trying to see how deep the roots were going. I told him, so let's dig the topsoil out first and put it in a pile. And then when we get the clay, we'll put it in a different pile, because then when we put it back, we'll put it back in the right order, right? We couldn't tell the difference. The whole profile looked the same color. And that black topsoil, that black soil zone, they've completely depleted all the organic matter out of it. Okay, so yes, doing this heals soil, but I got more water holding capacity. I've got more free nitrogen, because the more carbon you get in your soil, the carbon to nitrogen ratio balances out, you're going to get more nitrogen already in your soil. Okay, so yeah, that's just more production.
Steve, I got another quick question for you. And on that cropland, and I deal with a fair amount of cropland, do you do any grazing on annual production ground that is cover crops planted specifically, for soil health / grazing? Do you do much with that?
Yes, I've been working with a grain farmer. The first time I grazed his grain land was in 2002. The drought caused his crop to be not very good, so we went in and grazed it with cattle. He actually wanted to sell me the green feed bales. Right, it was an oats crop or a barley crop or something, and he wanted to sell me the bales. But we had a real dry period, and then that fall it did nothing but rain, kind of like this year here, very similar. And so he was trying to get it baled up, and it rained, and he didn't get it baled up, and now it's September and it's raining, and he can't get it baled up, and now it's October, and now it's December, and finally he agreed to let me graze it. So I put a fence around it. January 6th, I think it was. He finally gave up that he wasn't going to get those oats baled up. So we went out and grazed it that winter, and we did great. He made more money than he would have if he would have combined it, he said. And then ever since then, on and off for quite a few years, I've been working with this grain farmer. And about 3 years ago, he finally came to me and he said, well, I think I need to get some cows on my land all the time. So he had one piece that was always lowland. He said, most years I either can't seed it or I can't combine it. So I've never made money on this piece of land. You might as well rent it for pasture. Remember that $60 an acre stuff I told you I was renting that I shouldn't? Yeah, that's the one. But I'm experimenting. I'm learning on it because it's in the black soil zone, right? It's supposed to produce more. Anyway, but the idea behind that is now we've got cows there, and now we can get those cows on the other pieces of land. Okay, so the benefit I have now that I have cows there, we graze it for the summer, and then I went over a couple of years ago and we grazed 160, no, what was it? It was almost 180 or 190 acres of oats and peas that he seeded down. So we got to graze it. So not only did I graze the summer pasture, I had this all winter grazing as well over there. So there is a benefit that way as well. So we're weighing that out. Because we're there now, we get to graze the other stuff. And then we get to graze residues. He did seed a cover crop for me this year. He had another piece that just never seemed to produce. And of course, in a drought, it didn't do great this year either. But we put a funny fence around it. He's got his yield monitor so he can tell exactly where the land's good and where it's not. So we went out and we drove, or we basically built a fence, really funny shaped, around the bad land, is what he called it, the stuff that doesn't produce. So I get to graze that now for 4 years. The goal is to try and heal that. He's going to seed it down. We put some perennials in it. We'll see what it looks like next spring, if we keep it or if he seeds something else into it. But the goal is that I'm going to graze it for 4 years, and then he's going to take it back, and then I'll get another piece. If it heals it, he's happy, and we'll just move to another piece and try and heal the next piece of land. So
has he set up a budget, like, seed budget, like $30-40 an acre for that annual seeding? And if he hasn't, do you, so like I'm doing a lot with, so I live in Eastern Washington State, Spokane, right on the Washington-Idaho border. And we're doing a lot with, or starting to do a lot with planting cover crops in production ground specifically to graze. It's more expensive because it's production ground, but our theory is that we are going to grow better crops, which is back to your earlier statement, the better the land, every time it takes a bite, instead of gaining a pound, it should gain 1.5 pounds. It'll get more energy, more minerals. Have you done much on the budgeting side of, I'm going to invest $30-40 an acre?
Yeah, I mean, they definitely have all their numbers. They're very keen on numbers. And honestly, from the grain side of that so far, he's maybe breaking even. But he's going to, like, his whole thought process on that is heating the ground with the price of fertilizer going up, right? When he takes that land back in 4 years, probably won't have to hardly any fertilizer, right? We're trying to kickstart it. We've been abusing land for 50 years. You're not going to heal it in one. And that's the downside to the cover crops, is people try it and it doesn't really work, right? Well, it's going to take at least 4 years to get something going on that, right? I mean, you can't just heal land instantly. So he's very aware of that. I mean, I've been working with him since 2002, right? It's been a long time getting him to come around, but now he's pretty gung-ho about this. So, we're both experimenting. We're both playing with it, right? This is a drought year. Neither of us made money, right? It just didn't produce. And it was a brand new or a abused piece of land in my mind. I mean, he's treating it as well as you can with zero till and everything that he's doing, but trying to convert that over to a natural system, it's going to take some time. So, we're working on it. That's my experiment right now. I'm trying to learn how to get the grain farmer involved and how to make it make money. The other downside to that is if we have a wet year, right, we got to have some place for the cattle to go because that land is not healed yet. As soon as it gets a bunch of moisture on there, we're going to punch it out. We did that to one piece a few years ago. We took them over there in October, and then we ended up getting a wet fall and about 40 acres over there that we probably compaction and damage we did for that week when it was really wet. 4 or 5 years later, we still see it. So there's some downside to grazing cover crops too. If you're in a really dry environment, you could get away with it more. But if you end up getting a wet environment, you could punch it out and do a lot of damage. So you've got to have a backup plan. The one pasture down, the one about 20 miles away that I talked about, I took over 60 acres of grain land touching it. So there I've got some flexibility. I've got 1,100 acres of pasture with 60 acres of grain land, right? So if it's raining and wet, I just don't go in the grain land. Or if we're out there and it starts to rain, well, I just kick them out into another paddock, right? So I have some flexibility there. If you're just going to take over some grain land and start to graze cover crops, you better have a place for them to go if and when it gets really, really wet. So there's things you got to watch for, that's for sure. It's not a, you know, magic bullet by any means. Oh, we got another poll going on.
Yeah. I see people are starting to drop off, which fair enough. But if you could drop a couple of feedback answers in there, I would appreciate it. I had a question from Kevin, wondering about what's the largest herd of cow-calf pairs you'd recommend?
The largest herd of cow-calf pairs. Depends on your situation, but one of my limitations is water. Okay, with big herds of yearlings, big herds of cows, we don't have wells. Any wells that I use, they're usually not very high producing. You may, you know, 1, 2, 3, 4 gallons a minute type of thing. And a lot of the time I'm getting that from my landowner, which also supplies their house, right? So if all of a sudden my cows come up to drink and the wife's taking a shower and she runs out of water, how long do you think I'm going to have water for my cows, right? So I have to be very careful about that. A couple of my bigger pastures, I actually break it into 2 herds. The one pasture I have, it was just over 1,100 acres. And one time I said, okay, we're going to bring in 800 yearlings here and we're going to graze this one big mob and this is going to be wonderful. Oh my gosh, it was a disaster with water systems all summer. Even the ones pumping out of the dugout, I needed to upgrade everything. The cost to upgrade all my water sites, I think there's 13 water sites on that cell, was more than the cost of labor to manage 2 herds, right? So it was cheaper for me just to break it into 2 herds and graze 2, you know, put in some extra fencing and then graze it as 2 herds, and then I didn't have the water system stresses. So, you know, there's all sorts of different ways, but when you start calculating the economics behind it, and then you balance out the human resource component, right? If I upset my landowners too much, I lose the land. Okay, so it's worth doing a little bit more labor so I keep a hold of the land. I don't know if I answered the question. I forgot what the question was. Largest cow herd, yeah.
Yeah, herd size.
Oh, with cow-calf pairs too, that makes a big difference on how intense you graze, right? If you're going to be moving every day and you've got 400 head of cow-calf pairs, okay, it depends on your management. Are you just calling them through the gate? Are you going to herd them gently? Do they run and lose their calves, right? It makes a big difference on how you move them. But just think of that. If you move the herd and they all run through the gate, that baby calf that just lost mom now has to sniff 100 tails to find mom. Okay, compared to 30 head, you move them through the gate, that little baby calf runs around, sniffs 30 tails and finds mom, didn't miss a milking, right? That 400 head herd, that calf might have missed a milking every time you move. So the weaning weight's going to be 100 pounds less at the end of the season. So you have to balance it off for your system, your management, but there are things to watch out for. So I don't know if I really answered that question, but.
I see we have applause, so that's something. Lynn was wondering if you tried timeless fence posts at all, or any idea about how they'd hold up in the winter.
Timeless? No, I haven't heard of that one. Sorry, no help on that one. What's the advantage? What's the specialty about them?
Steve, they're a recycled plastic fence post that goes in. They're supposed to basically last forever.
I remember buying some PowerFlex posts. So they were a certain material and they were self-insulating. You just had to use a cotter pin to hold the wire on and stuff. But when the moose go through them, they still bent over. They were supposed to be able to flex and bend and whatever. So lots of them are still out there perfectly fine, but I got a few of them over there that are broken because, you know, a moose went through it and pulled them over or whatever. So comes down to your labor and equipment cost as well. Okay. If you need a tractor and a post pounder to go in, put in wood posts, versus you just drive out with a quad and a hammer and you can pound in a little post. Okay, which one's going to cost you more in labor? Depends on the price of the post. In my environment over the last few years, not this year, because the price went through the roof this year on fence posts, but most years, we got grain farmers pulling fence out all the time. Right, I can buy used fence posts from some grain farmer for $1 or $2 a post. So it's not that big of a deal to rent a post pounder or to put the value of a rented post pounder on yours, and go out and pound the posts and get it done, and less physical labor, right? When someone was trying to sell me a fancy post, but well, then I got to hand pound them all, right? I'm not really interested in that. I'm getting older, and that doesn't sound like a lot of fun anymore. So it comes down to your situation, but the economics really helps you make some decisions, and then you weigh out your, the pros and cons of what you're doing. But so yeah, I've used a bunch of different types of fence posts. I always go back to my wood post and high tensile wire. That's pretty well my favorite.
All right.
Is using the valuable lifetime, like how many years this investment will last you, the best way or an easy way to figure out amortization, how many years you're going to amortize it over?
Yeah, and it could be different, right? If you, like I said, those poly wire with step-in posts, they might not last as long, right? In my environment, the wildlife are pretty hard on that. I get some of my pastures I've done poly wire on before, and I get so frustrated after 4 or 5 years because there's so many knots and so many repairs, and now the power's not going through it because the wires or the metal wires are broken, but the poly's still connected. And you know what I've learned over the years, just throw in the high tensile wire in the wood post and it's done. The moose don't break it, and I don't even use an insulator. And slap my fingers, any fencing companies out there, plastic insulators break off, the moose knock them off. I'm constantly fixing posts. In my environment, I'm not super wet, so I can usually get away with no insulators. I just don't power the entire fence, right? If I've got 1,100 acres, there's no sense powering the whole thing, right? I'd rather have a couple of smaller fencers and just power one little area and then move that with the herd. And then it's a lot less fence to check, and I can get away with no insulators and I'm fine, right? If I can get, when it's dry, I've got 7 kilovolts in my fence. When it rains, I drop to 4. But the cattle are still quite respectful of it, right? I haven't had any major problems. So if you're in a really wet area, you're getting 40, 50 inches of rain in a season, yeah, maybe that won't work for you, but I can get away with it.
Right.
Here's one. If you use that same calculator for something like a compost profit center, would you have a cost related to the feedstock if it's cow manure from a winter feeding system in a corral, other than hauling it out?
Would there be any input cost to it? Can you sell your manure to somebody else, right? We've got to look at our inputs and our outputs as a market value. If there's a value that you can sell it for, then maybe you need to buy it off yourself, right? Maybe manure is not a good example, but if you were in, let's say you were growing barley and you had a dairy, right? You have to sell the barley to the dairy at market value. If you sell it at cost, your numbers are going to be skewed. So it depends if that manure has a market value or not. If it's just a byproduct that you got to get rid of, or what's the value of it to go out on the land as manure versus the value of that going into the compost to get it composted and then sold or distributed after, right? Is there a value that you could just sell that manure to somebody else, right? Every profit center, you got to kind of look at that. What's the market value? What could I get if I sold it or if I had to buy it? What's the value?
Awesome. Thank you, everybody, for coming. I see where people are starting to sign off. So thank you for coming. Tomorrow, we'll be talking about finances and stuff at 3 o'clock Mountain Standard Time. But we will...
I see a comment in the chat. I'm about 20 messages behind here. Sorry. I haven't seen him. I just saw something about Greg Judy's a big fan. I'm not sure what that was about, but that gives me a little leeway. Next Wednesday night networking, guess who our special guest is?
Hey.
Greg Judy's coming in. He's going to be our special guest next Wednesday. So that's pretty cool. And I guess the other thing that I have coming up on November 27th, we've got an online one-day grazing school. If anybody wants to just look at the grazing, not the economics behind it, but the actual grazing principles and concepts and cell design and stuff like that. That'll be on November 27th.
Awesome.
So
Yeah,
that's what
Greg
we've got for.
Sorry,
No, go
interrupted
ahead.
you again. Greg Judy's on November 24th. And then as a Christmas present to you, December 22nd, we're bringing in Temple Grandin for our Wednesday night networking. So that'll be a big one.
Right on. And yeah, for anybody who's going to miss tomorrow's presentation, I will be sending out the link to that recording and this recording here early next week, hopefully. Once I've got the whole thing prettied up a little bit, it'll go out. So, but I know I have some time. How do you join the Wednesday night networking, Steve?
The Gateway Research Organization, if you go to their website, they'll have a virtual networking area that you can select. I could probably find it quick if yeah, give me 12 seconds and I should be able to find it. Okay, maybe more than 12 because something's freezing up on me.
Steve, I'm gonna test your multitasking skills. Taking out a loan for for a capital project, would you put the loan payment plus interest would you divide it by what percentage of the principal of that loan is going to fencing, water infrastructure, purchase of animals, or would you put it as an overhead cost?
Neither. So any loans that you have are in finances. Okay. When we're looking at economics, they're ignored. We cover that with our opportunity cost. Okay. I talked about opportunity cost, but really didn't get into it today because I simplified it.
Yeah.
But if we're doing the whole gross margin analysis, we put an opportunity cost on everything, whether you own it or not. So that's just like an interest charge on your loan. So we ignore all the loans and we put an opportunity cost on everything. When we look at our cash flow, well, that's when your payment goes in, right? Oh, here's my payment. We got to throw that in here every month. We're going to make this payment. Okay, so economics, I ignore it because we're already covering it.
Okay.
Hey, Steve, do you ever rest the pen on your paddocks? Do you ever rest them for a year, let them go back, or do you...
Yes, I would call that deferred grazing. If I've got one, let's say I have 20 paddocks in a pasture. If I'm having a decent year, right, we get a decent amount of moisture, just about all the time, I'll pick one paddock and let it go. We might graze it once, but then I'll let it go and I let it mature, I let it go to seed, and then we stomp it to the ground either that fall or maybe the next spring. Okay, so it's a way to add litter to the soil and add seed to the seed bank, but I'll usually pick the worst one, right? Which one's the least productive? Because if I've got 20 paddocks, well, pulling one out doesn't really hurt me that much, right? But if I do that, every other year or do it 3 years in a row, and then maybe on a dry year, we graze everything. But, over time, those poor producing paddocks, you can get some good recovery on them.
Okay, good to know. Thanks.
That's been my most successful rejuvenation tool, right? And it might not be dramatic. I got caught the other night. I did a talk, and I told them that right at the beginning of the presentation, I said, there's no magic bullets, right? If you're here, there's no magic bullets. You're not going to find a quick, simple fix here. And then at the end in our question and answer, they asked me about bale grazing. And I said, oh, you caught me. The only magic bullet I've ever found in pasture management is bale grazing, right? You can instantly fix it. That's the only thing I've ever done that is like, boom, fixed it. Problem is you cover very little ground, right? I got 3,500 acres to cover. In a winter with 300 head, I might be able to cover 35 acres. Okay, so it is a magic bullet, but on a very small piece. So the rest of my land, how do I heal it? How do I bring it back from an abused piece of pasture to a nice productive piece of land? And that deferred grazing is a big part of that, right? I'll get, that one paddock that just isn't doing anything, just let it go. But you can't do that all the time because eventually it'll get stagnant, and right. They've talked about, areas they've protected, and the government comes in and protects this whole area and gets rid of all the grazing out of it. Well, it goes backwards. Okay, but 1 year of it and then stomp it to the ground, leave that litter over top. That gets me my water, right? Leaving that litter helps with evaporation and with runoff. Once I've got the water, now everything else kicks into gear, and I can get it productive. Thanks, Brittany. I learned all sorts of stuff in college and university as well, and one trip to the Ranching for Profit school, 6 days worth of education. I learned more there than I would have in 4 years of university. So it's amazing. If you get the right stuff, you can learn it. It's way more valuable. So tomorrow night, we're going to talk about finances, and then we're going to look at a cash flow, and same thing, we'll give you the cash flow to take home.
Ranching for Profit ever coming to Canada? Well, I know they have done schools in Canada before, but
I don't think so.
not
they had
this
trouble.
year for sure.
They used to, but then they had trouble coming across the border. I remember one time when Dave Pratt was the owner, he came across the border and they shut him down, right? They had the whole school booked the whole week long, and they wouldn't let him across the border, right? And just turn around. So the whole school got canceled last minute. So that kind of ended that, because it, definitely hurt the reputation. Now Dallas Mount owns it, and he was talking about doing a little bit in Canada. And then COVID kind of hit. So I think he's got to get a Canadian instructor maybe to make that work, but we'll see. As of right now, I don't think so, but that's not necessarily written in stone.
Yeah, I know they're having one close to Canada. I believe they're planning one in Minot, North Dakota here for February or March. Don't quote me on the date, but they are planning one in Minot, North Dakota. So that's hop south of Saskatchewan.
Yep.
Yeah, I was chatting with him here a while ago. I know he's got a couple of schools. They're thinking about Canadians, but they're not able to come across the border. So
yeah, well, we kind of had that problem, didn't we, Johanna? What was this supposed to be?
Yeah,
a Joel Salatin, Steve Kenyon school. Yeah, couldn't get Joel up here.
Yeah, gotta love the whole international speaker thing.
Yeah, December 1st and 2nd, I'm in Bismarck, North Dakota, doing a 2-day school. And then I'm in January, I actually go to Montana to do a 2-day school and a seminar. And then in 2 conferences in South Dakota at the end of January. And then hopefully a bunch across Canada here yet, because we got the grazing mentorship program we're trying to roll out. So
a grazing mentorship program?
Yeah, years ago there was it was called the Sustainable Grazing Mentorship Program. I think it started in about 2003, maybe. It was in Alberta for a few years, and then we spread it across Canada, and then it kind of petered out. And then even in Alberta, then it died a couple of years after that. So I think it was just a little bit before its time. I was on the original organizing group and I helped set it up, and I was one of the mentors, but like I said, it kind of just petered out. Now with all the climate change issues and the federal government's goal on, carbon reduction and carbon sequestration, well, this program just got a whole bunch of money thrown at it. So we are going to set it up and spread it across Canada. And my job's to kind of organize it and train the trainers. So I'm going to teach a bunch of people how to be mentors, how to teach this stuff. And then every province is going to kind of roll it out their own way. But yeah, we're hoping to have that up and running before the grass turns green.
Cool.
That's my winter job this winter.
Gotta have something to keep you busy.
Well, yeah, as of today, I'm officially done my grazing season. I am out of pigs as of 2 days ago, and as of just 4 hours ago, I shipped my last herd of bred heifers out. So,
I have a question about your how you do your potential profit. So versus if you're charging yourself. So say let's say you have a 4-wheeler or quad, whatever you want to call it. But so you're charging yourself or charging, yourself for using that, but then there's also the potential to make money, say renting that out. How do you put that into your system so you're not charging yourself twice, essentially? Does that make sense?
market value, right? If you're going to charge it out, if you could rent it out or charge it out to somebody else, then that's what you should charge yourself. Should be pretty straightforward. Should be the same number.
But for opportunity, so like you were talking about the opportunity cost of, you know, renting it. So you wouldn't charge, or you wouldn't account for that if you're accounting for renting it yourself, to yourself rather?
Yeah, it should be the same. In my full gross margin analysis, I've got a profit center that is basically an equipment profit center, right? For some really big farms, this is where this comes in. Really big farms, it kind of tells you whether or not you should own the equipment or which equipment to own. So you set up a profit center that's just equipment, and then it's responsible for the repairs and the fuel and the maintenance and everything on that equipment. And then you rent it out to the other profit centers. So if you've got a tractor per se, it does so many hours feeding the cows, it does so many hours feeding the goats, and so many hours making hay, and so many hours doing whatever else. And you start billing those out accordingly, give it a reasonable hourly rate like we did. Then it's responsible for all the repairs, the fuel, everything else on insurance, whatever you need. And then you can start making decisions out of that. Okay. Should I be making my own hay? Should I be making hay with my own equipment? Or should I get a custom guy in to make my hay? Okay. Now there's risk value, right? Risk and human resource issues with that. But purely on an economic basis, you could make a decision. You know what? It's not worth owning the equipment to do this profit center. Or, you know what? This profit center it is. I remember years ago when I first got into this, all the holistic management guys and the Ranch for Profit and all the courses that I took, right? I heard all sorts of phrases like, don't own any iron, get rid of anything that rusts. You shouldn't own anything any bigger than a wheelbarrow, right? So that was the mentality that was thrown at me all the time. But I got into it and I learned the gross margin analysis, and I'm like, well, that's not necessarily true, because if a piece of equipment makes me money, I should own it, right? I'm in Alberta, maybe not right now, but on most years, if I bought a trackhoe and put it in the oil field, I could make some good money, right? I could hire a guy to work it, and then now I got human resources issues to deal with, so that's another ballpark. But in theory, if I can make a profit on that piece of equipment, then there's no reason why I wouldn't own it. Okay, if we're taking into account depreciation and opportunity cost and inflation and labor costs and all those things, if it's making a profit, I should own it. Same thing with your equipment on the farm, right? My little sidekick, it makes money, right? There's a good reason why I own it, because it's really cheap to operate, and I can make a lot of money because I'm running around managing all these cattle. So there's a good reason to own it. My bale truck, same thing, right? If I'm feeding 300 or 400 head that winter and I'm running my bale truck out there, it's very efficient. It's making money. If I'm only feeding 30 head, well, maybe it's not making money. Right? So there's a value there depending on how many animals it's dividing out for too. So I don't believe those phrases about don't own anything that rusts and, get rid of all the iron, because sometimes they are worthwhile owning, right? You just have to run the numbers on them. So if you set it up as its own profit center, it can tell you, and then there's other decisions to make, right? I'm going to make, making a little bit of money on my hay, but maybe according to the numbers, I shouldn't own my own equipment. I'm losing money on the equipment, so maybe I should get a custom guy in. Well, if the custom guy doesn't show up when I want him to, then my hay's worth less because it got rained on 3 times. So then there's a value there. Okay, so I'm going to take a little bit of a loss on the equipment because I want to make sure I have good quality hay, right? So we have human resource decisions to make on top of the economic decision. Noah, you have a question. So opportunity and rent for the equipment goes in 2 different profit centers. Do you want to explain that one a little better?
Yeah, that was my question I just asked there, where I was asking about like the 4-wheeler. So that it would be 2 different.
Oh, same one. Okay.
Yeah.
I thought you were adding to it. Yeah, no problem. There's 2 of you. How come there's 2 of you? You're on the screen twice.
2 of us.
You have twins.
Oh,
yeah,
probably my computer. Yeah, my computer logged out or shut off because the battery died, so I had to plug it in.
Oh,
okay. Logged in.
That'll do it.
I'd like to duplicate myself sometimes to get more work done. All right. Oh, and we're down to one page, Johanna.
We are.
22. Yeah. So any other burning questions? Or are we starting to fade out?
I had one for you, Steve. You had mentioned earlier that there was 3 different profit centers related to cows, and the custom grazing one was the one you went through, and then the cow calf was the second one, like owning the cows. What was the third one?
Land ownership. Right. I have landowners. They own land. That's all they do. They invest in land. So,
okay.
Yeah. And there could be a hay profit center in there too, right? Somebody makes the hay and the cow guy buys it.
So coming from a guy that owns the own land, owns the cows, all that, I would have to work out all 3 profit centers, or possibly 4.
Yes. I mean, it seems like more work, but what it does is ends up giving you the ability to make decisions better. Okay. If it shows up that owning the cows is where you make the money and you're losing money at the grazing, well, that could tell you should send your cows to somebody else to graze. Okay. Or, you know, in reality, in my situation in the past, not right now this year, but I have had all 3 of those profit centers, right? I don't own the land. I lease all my land. So we have landowners that all they are investors. Okay. I'm the custom grazer. I don't own the land. I don't own the animals. And then I've got a customer that comes in that I custom graze for. They just own livestock. And I've actually had people that don't even have a farm. They just bought animals and I manage them. Now that could be summer and winter. Okay. So even in the wintertime, now we got a hay guy that we bought hay from. He's the hay producer, totally different person. I bring him in, somebody else's cows, somebody else's hay. I'm the grazer or the custom feeder in this case. Somebody else owns the land. Okay. So a lot of farms, you're everything. But when you're doing the economics, break it into pieces, because then you can decide which ones are making you the money and which ones are not. Okay. It might show up that all of a sudden you're not making any money on your hay profit center. You're better off to buy hay, right? All of a sudden that you quit doing that. If you're losing money on hay, all of a sudden now you're buying hay and you make more money and you have more time for grazing. You have more time for whatever else. I'm assuming that was good enough. So what did you guys figure out of your polls? Any good information?
Let me pull that up again. Most people learned something, and we didn't have anybody say that the webinar was bad, so that was good.
Oh, it wasn't a waste of anybody's time. Whew.
Yeah. And we've got about 52% of people are coming to the webinar tomorrow. 46 said they might, but they'll probably catch the recording if they don't. So that was.
Who was the farthest away?
I was going to ask if you ever discovered who the out of country or out of North America person was.
Yeah, they never did.
We never found that out, but I was going through our registrations and we did have 2 registrations from the UK and 3 out of Australia.
I know the time zone's a little hard for them probably.
Yeah, I was chatting with a guy from the UK on Facebook. He couldn't make it to this one because it's at 2 a.m. his time. But tomorrow's is going to be at about 10 p.m. So he was thinking he could maybe make that one.
We had a lady from Ireland on Wednesday night networking quite a few times last winter. And it's 3 a.m. at her place, but she's no, I'm going to be there. I'll be there, she said.
All right.
That's dedication.
More power to her. We have even had a couple of people from Eastern Canada, which is fun.
It's getting later over there too.
Yeah.
Yes, Kent, I just saw your message in the email or in the chat. You are registered for tomorrow. It's just a 1 registration thing and you get both sessions. So
yes. Yeah. There should be an email go out tomorrow with the link for tomorrow, but it's the same link as tonight. So you should be good to go there.
It's like buying pizza, 2 for 1.
Yeah.
Sorry. My daughters are expert eye rollers. I told my youngest daughter a little while ago, I said, do you know how hard it is to try and make a joke out of everything you say? And guess what? She rolled her eyes at me.
That sounds about right.
Yeah. Yeah.
Alrighty.
This is kind of like the storybook about monkeys jumping on the bed. One fell off and broke his head. We're slowly dwindling down to numbers here.
Yeah. All right.
I have a question. Oh,
okay.
Am I too late?
No, go
I
ahead.
just had one question. With where I am, there's not a huge demand for the custom grazing. How do you get into that? Like I said, I know there's not a high demand, but how did you get into it to where you were able to find people that wanted to have you graze their animals? Is it just easier because there's more farms that are doing that there, or?
I'm going to say it's easier now because we have social media, right? For me to find customers before, I don't even remember where I did to begin with. It was word of mouth through a feedlot or through a buyer or through a trucker, or right? Like human resources, like I said, is the most important part. The number of truckers, I have one trucker show up at my place and he knows, 10 other cattle owners, and all of a sudden people are phoning me for that. And now you just post on social media, hey, we got pasture available, and 4 or 5 people will phone you up and say, hey, I need some pasture. In my area, I turn away 1,000 to 5,000 head every summer, right? Like we've got lots of demand, mostly cows, and I prefer not to have cows. So I'm a little fussy. I try and get what I want. And now I have some long-term, some customers that are there for multiple years, so they get priority, but I've never not filled up. So now with social media, it's so much easier. So if you're in an area where there's not much, either it's because the market value is not there, or maybe just because nobody realizes they could do it. Throw it out there and find out if somebody's looking for extra grass, and just say, well, we do it on a custom basis. So it's going to be a little bit more, right? You got to be able to negotiate that with them. If they rented the land, they could get it for, I don't know, $1 a day. But if you're going to do the work, well, for you to charge $1.50, well, there's 50 cents for you to do all the work, and they never have to come. So you're going to have to negotiate back and forth and discuss that with them. And some people don't even, they don't understand that. Like, no, I only pay $1 a day. Well, that's $1 a day when you do the work. It's $1.50 a day when I do the work. So, and some people they just won't do that. So depends on the area, how conservative they are, and if they're desperate for land or if they're not, right? That's another part.
Thank you.
Who was going to be the refugee here? Going through the chat, somebody said someone should be a refugee.
I believe that was talk about ranching for profit yet.
Oh, okay. Yeah.
Well, with that, I guess we'll sign off for tonight. We'll see everybody tomorrow.
Going once, going twice, sold.
Thanks, Steve. We'll see you tomorrow.
Betcha. See you guys later.